Hi, Else here, and today we'll be talking about subsequent events. What is a subsequent event? It's an event that occurs between a business's year-end date and the date that the financial statements are approved for issue. What does that mean? Let's look at a timeline to see. A fiscal year has a start date and a year-end date. The fiscal year lasts either 1 year or an operating cycle, whichever is longer. I made this fiscal year 1 year, ending December 31st. Note that 2/3 of all companies have a year-end date that's December 31st or close to it, so it makes sense that you frequently see this date as a year-end date for companies in textbooks. Between the start and end dates of the fiscal year is the reporting period. All transactions that take place during this period must be reported in the financial statements. That's the basis of accrual accounting, which is required under IFRS and ASPE. The year-end date is the cutoff point for recognizing transactions in that fiscal period. The cutoff date is the point when one reporting period ends and the next one starts. However, after the year end, several weeks or months may pass before the Board of Directors approves the financial statements for issue. During that time, the business will do things like count and price inventory, prepare adjusting entries, ensure the accounting records are complete, and have the financial statements audited. This period between the cutoff date and the date when the financial statements are approved is called the subsequent events period. During this period, events that impact the company's business in a significant way may occur. If material, should these events be reflected in the financial statements, even though they happened after the cutoff date? The simple answer is yes. If the events are material, the stakeholders would need this information to help them predict the future and make decisions. Without this information, the financial statements may be misleading. However, the answer is far more complicated than that. It actually depends on what the event is and when it happened. Subsequent events are divided into two types: adjusting events and non-adjusting events. Let's cover each individually. Events in the subsequent event period are adjusting events if the actual condition existed before the cutoff date, but in the subsequent period, additional evidence comes to light that allows the company to improve the measurement of a previous estimate. This includes information that would have been recorded in the accounts if it had been known at the cutoff date. This means that, with regards to measurement, the preparers should use the best information available, including information available during the subsequent events period, as long as the condition existed during the reporting period. That's critical. Let's clarify this concept with a few examples using the timeline. Assume there is a major technological change and you find out about it during the subsequent event period, say February 12th. This change will make your inventory worth far less because few customers will want to buy it anymore. You found out about that change in the subsequent events period, but what if the technological change actually occurred on November 21st? Note that the condition, the technological change, existed before the cutoff date. Even though the evidence of the change was found during the subsequent events period, the measurement of inventory owned at year-end must be adjusted, written down to the lower of cost or net realizable value. This meets the requirements of an adjusting event, which means that the adjusting entry must be recorded in the accounting system and the updated value of inventory must be reported on the financial statements, even though the evidence was discovered during the subsequent events period. Let's do another example. Say that a customer declares bankruptcy on March 12th before the financial statements are approved for issue. Would this fact be reflected in the year-end financial statements by adjusting the accounts? The answer is yes. The financial statements would be adjusted. For estimates such as the allowance for doubtful accounts, information during the subsequent events period is used to determine the allowance, including actual collections and defaults. Why? Because it's likely the customer was already in financial difficulty before the cutoff date. We can adjust the measurement of AFDA. This is also true for accounts such as sales returns and allowances, which are often estimated at period end. Let's do one more example. Say that a lawsuit was settled during the subsequent events period. on January 31st, with your company on the hook for $2 million of damages. If the event that caused the lawsuit happened within the reporting period, say in June of the reporting period, then the settlement of the lawsuit must be reported in the year-end financial statements by recording a loss on the income statement and a liability on the balance sheet. This is again because the condition existed before the year-end date. The evidence, in the form of the settlement, was available in the subsequent events period, and that affects the way you would measure the impact of the lawsuit on the company. Let's now turn our attention to non-adjusting events. These are events where the condition did not exist before the cutoff date. An example would be an accident that destroys a factory on January 28th. Although the factory definitely existed before the cutoff date, the destruction did not happen before the cutoff date. The evidence is again available in the subsequent events period, but this new evidence would never affect the amounts on the financial statements. There would be no adjustment to the account balances. Why not? Let's look at an example using the timeline to see why there are no adjustments necessary. Say that on February 9th, there is a severe decline in financial markets, and suddenly the investment your company made in the shares of Apple Inc. take a dive. Your investment, a long-term asset on your balance sheet, is now worth half of what it was at year-end. Should the value of your investment be adjusted on the December 31st financial statements? The answer is absolutely not. Why not? Because the condition of the market changed after the cutoff date, not before. Even though the evidence, which would be the decline in the market, happened in the subsequent events period, it would never impact the measurement of the accounts on the financial statements at year-end. Why not? Because the condition did not exist before the cutoff date. Other examples of non-adjusting events would be the loss of assets due to fire, flood, hurricane, etc. A lawsuit where the event, such as the patent infringement, happened after the cutoff date in the subsequent period. Or the sale of a company's shares, the purchase of another company, the issue of new debt. The list goes on. So, can we totally ignore all non-adjusting events? Absolutely not. If the event materially affects the assets, liabilities, or future operations of the business, it must be disclosed in the notes to the financial statements at a minimum. It may also result in supplemental schedules, or, if very material, it may require supplemental financial statements. These would be prepared to show what the financial position would be if the event had occurred before the balance sheet date. Anything necessary to ensure that stakeholders clearly understand the impact of the subsequent events on the business's financial position or profitability in the future. This is required to ensure the company is following full disclosure. Let's just summarize everything we've learned. In both adjusting and non-adjusting events, the evidence is always available in the subsequent events period. But for adjusting events, the condition existed before the cutoff date in the reporting period, which is why the event affects the measurement of the estimates and is recorded as an adjustment in the financial statements of the reporting period. This is very different than non-adjusting events, where the condition exists after the cutoff date, after the reporting period, which is why the financial statements are never adjusted for measurement. Let's check your understanding, just to be sure you got the idea. Remember to pause the video and answer the question before I do it for you. Your company purchased a property in downtown Toronto for $1.2 million. The property used to be a gas station, and your company plans to develop it as a rental property. During the subsequent event period, you discover that the soil on the property is contaminated and the value of the land is severely impaired. Is this a subsequent event that requires an adjustment or a non-adjusting subsequent event? The answer is A, an adjusting event. The land should be written down because the contamination existed before the cutoff date and it materially affects the measurement of the land value. The land should be written down and the new lower value would be reported on the year-end financial statements. That's it for subsequent events. Thank you so much for watching my video. I hope you found it helpful for your learning.